What's up, guys? Welcome back to another video. Thanks for tuning in to Stock Essentials. My name is Alex, and today we're going to be going over NEWEGG Commerce stock, ticker symbol NEGG. This stock is absolutely exploding in the market off of news of GPUs as well as delivering custom PCs directly to your doorstep. So a lot of the Wall Street Bets traders are hopping into this stock, and right now it's mainly a sense of FOMO. They see the stock up so much, so they end up buying into it, creating the price to drive even further. So you gotta be very careful when playing this stock. I definitely would not recommend buying at this current price point. Absolutely insane, up 245% in the past week, and just these last 2 days alone, it just tripled, quadrupled in price, all the way from around $15 starting the beginning of last week. So this stock ended up being around a few cents and a few dollars, and it kept running up until these past few days. So you got to be very careful when something runs up this fast, because as fast as something can run up, it can also tank just as fast, because people are going to want to sell and take profits. They see 150% return in a day, and they decide to cash out. So that's the price psychology behind that. As fast as it rises, it can tank just as fast. You gotta be careful. So I do think it's a little bit overextended. A lot of people are buying the stock solely because they don't want to miss out on the huge price action. So I do think eventually the price will come down to around maybe like mid 20s or even lower. But for now, there's a ton of talk about the stock, ton of hype, and it's a good opportunity to play options, although it is a kind of risky. But if you play options right, you could see some amplified returns. So I don't recommend buying options, buying calls, or buying puts. Even if you're bearish, put options are very expensive right now. Implied volatility is over 500%, meaning the price for puts are going to be inflated as well. So if implied volatility happens to drop, you're going to be losing a lot of money. And that's where Vega comes into play. For every drop in 1% of implied volatility, the price of the premium is going to drop by the Vega. So it's going to drop $2 every drop in implied volatility. And there is a ton of implied volatility. So if this stock remains flat or ends up dropping, a lot of people sell off. Implied volatility is going to drop as well, and the price of your premiums will drop, even though the price of the stock is dropping as well. So even though you're buying puts and even though the stock is dropping, you can still lose money on your put options because of the drop in implied volatility. So that's why if you're bearish, I do not recommend buying puts. But you could buy it as a lottery ticket if you want, of course. So the strategy I would recommend is actually selling puts. So right now the options chain only goes up to $40, and we will make another video on that because the best options play to make on this would be a call credit spread for a higher strike price than what these currently offer. So right now we're just waiting for the options chain to be updated to more accurately reflect the current stock price. But for now, the best options strategy would be to sell cash secured puts. So you could sell like a $20 strike for $118. And if you don't think it's going to go that low, all the way to $20, which is like a minus 66% drop in a few days, you could do something like a $30 strike price for $350 of premium. That means the stock has to drop 50% within a week and a half. And that's a pretty safe bet. You can possibly make around a 10%, a little more than 10% return in just a week and a half on your money. So let's take a look at this option right here. $30 short put, which is a cash secure put, receive a credit of $350. Let's do one contract. But we do have to put down a collateral of $3,000. I did a community poll asking what your guys' portfolio sizes are to more accurately reflect these option strategies for you guys, and it seems like something around this would be pretty good as well. So $3,000 collateral, receive a credit of $350. Basically what this contract means is as long as NEWEGG stays above $30, you're going to make your full profit of $350. If NEWEGG drops below $30, you're going to have to buy 100 shares at $30 each by expiration. So if you think that NEWEGG will at least stay above $30, this would be a good option. If you're a little more bullish and you don't think, if you think 30 is a little bit low, you could do a $40 strike. You could even drag out the expiration date because implied volatility is very high. We want to capitalize on the time decay. August 20th offers some really good premiums on these contracts. As we can see here, a $30 strike is going to give you $835 of premium, which is a lot. And if you even want to do a $40 strike, you receive almost $1,500 of premium. But it is kind of risky, as we mentioned earlier. As fast as a stock could rise, it could also tank just as fast. But for the long term, I think this is a good company. But we do have to be mindful of the price action. It's a lot of FOMO driving the price up, and we gotta play it a little safer. So if you want to be safe, you could do a $20 strike for $360 of premium expiring August 20th, which is pretty good. So as long as it stays above $20, you're going to be chilling. And my plan on this is to sell probably July 16, maybe an August 20th as well. But implied volatility is very high, as we mentioned earlier, 560%. So my strategy here is I'm not really going to hold it till expiration. I'm just going to wait until implied volatility gets crushed, because once implied volatility gets crushed, the premiums on these contracts are going to get crushed as well, and then we can buy back these contracts for a nice profit. So that's going to be my strategy going forward until NEWEGG options comes out with some higher strike prices. I'm going to be looking to sell some call credit spreads once the option chain is updated, probably around maybe like a 70 strike price depending on the premiums. So we will be taking a look at that later on. But right now, selling some cash secured puts, that looks like a very valuable strategy. There's not many options right now that a lot of people can buy, so they're flooding into these these out of the money put options. So premiums are pretty high. And if you want to be safe, of course, go down the strike prices. Even a $15 cash secured put will yield you $50 of premium. You're most likely going to be winning on that, as we can see here, 90% chance of profit. So if you want to be safer, something like that could be pretty good. But I personally am probably going to do either a $20, anywhere between $20 and $30 cash secured put, and we will receive some pretty nice premium for that. $30 cash secured put in a week and a half is going to yield you $350 premium, which is about over 10% return just a week and a half. Think about that. That's a pretty good return, considering the average return in the market is around 10-12% per year. So that's about it for this video. If it helped you in any way, please leave a like, comment down below what your thoughts are on NEWEGG options. We are going to be making some more videos on this to take advantage of the higher implied volatility, because it does present a good opportunity to play options. But remember, do not buy options. It's better to sell it on these high implied volatility stocks. That's about it. Thanks for watching.